Hi, I'm Max Keiser, and welcome to the Keiser Report. You know, you've heard a lot about pigs. Portugal, Italy, Ireland, Greece, Spain. But you know, I still think that the biggest pigs are Fannie Mae and Freddie Mac. Oink, oink, oink. I'll tell you why. I just got this off BusinessInsider.com. Fannie Mae and Freddie Mac are losing $150 billion. Remember? The American people already bailed these people out. They're still losing hundreds of billions of dollars. They're foreclosing on homeowners whose mortgages they guaranteed. They're maintaining the house for a while using U.S. taxpayer money, $10 million this summer for lawn mowing. Then they're reselling the houses at a huge loss. And then in many cases, they're underwriting a new mortgage for the buyer, generating more fees for the financial terrorists on Wall Street, the Goldmans, the J.P. Morgans, the jihadis on Wall Street. And you had better hope the house price crash is over, or 2 years from now, we'll just be doing this all over again. And of course, house prices are still on the way down because the world is caught in a global deflationary spiral that has many more quarters yet to unwind. Yes, that's just some of the stories we'll be talking about here in the Keiser Report today. Stacy Herbert, tell me more!
Max, so one of our big themes is the currency grid and the volatility of currencies during this global debt deflation. And we see in the past week, China has announced that they're going to revalue the yuan. Nobody knows for sure how much or if it's really legitimate. Germany and France are also reportedly considering a two-tier euro. And gold is soaring.
I told you last week and the week before and 3 months ago, you gotta buy. It's going higher.
So the first story, Germany and France examine two-tier euro. According to an unnamed official who told the Daily Telegraph in the UK, Germany and France are examining ways of creating a two-tier euro in order to separate stronger northern European countries from the weaker southern ones. The creation of the super eurozone would initially include France, Germany, Holland, Austria, Denmark, and Finland. This official tells the Telegraph that, quote, it's an act of desperation. They're not talking about ideal solution, but the lesser of evils. Helping Greece could be done relatively cheaply, but Spain, they can't afford to let fail or bail out.
It's the reverse Marshall Plan. Remember, after World War II, the U.S. dumped in hundreds of billions for the Marshall Plan, rebuild Europe. Now they're taking it all back in the form of credit default swaps and other derivatives that they flooded the European banking system with. Now they're pulling the rug out from underneath Europe, Eurozone, and the currency's going to have to split up into 1 million pieces. Forget 2 currencies. It's going to go back to 27 currencies, 57 currencies, 1,000 different currencies. It's a complete splinter fest.
Well, the argument is that the northern European currency would become very strong, and thus the southern one would fall and help, therefore, those people devalue their debts, rather than to have the French and German populations bail out.
Yeah, reconstituted Germany. Trust me, their currency is going to be very strong, and it could be a problem.
And the next headline along the same line, Fitch threatens ECB. You'd better buy hundreds of billions of toxic assets from our clients or Europe gets it. So Fitch Ratings has warned that it may take massive asset purchases by the European Central Bank to prevent Europe's sovereign debt crisis from escalating out of control. So Fitch is warning that European banks have nearly 2 trillion euros of long-term debt by the end of 2012 that it has to roll over. And they're warning the ECB that they better start buying some because otherwise there's going to be a debt crisis. Who are Fitch's clients?
Wall Street banks?
The very same ones that Fitch gave AAA ratings to all their junk bonds, which has caused the crisis.
It's the reverse Marshall Plan. They loaned the money to Europe for 60 years. Now they're taking it all back.
Here's a quote from Brian Colton, Fitch agency's head of sovereign ratings. He says, quote, there has been an unwillingness, he's referring to the Germans on the ECB, to follow through, and markets are going to want to see the ECB's money.
A reconstituted Germany. Trust me, there's going to be a big story coming soon.
But for all of Fitch's talk, gold is walking the walk.
Yeah, baby, gold. We've been talking to you about it for weeks. You got to own it. You can't own enough of it. Gold, gold, gold.
Gold hits $12.65. This was on Monday. Of course, gold soared. And let's look at some of the reasons why people are, analysts are saying that gold is rising.
Aside from my recommendation?
Many have been saying that gold is a hedge against inflation. And naysayers about gold have been saying, well, where's the inflation? There is no inflation. So why are people buying gold? Don Cox dissects gold as the oldest established store of value moves to center stage. This is Don Cox of BMO Capital Markets. And he says, quote, "We believe that gold's recent rise began when investors sought a classic inflation hedge, but its real run came when deflation risks were far more obvious than any evidence of inflation."
That's right. It's acting as a store of value in a deflationary environment. This has got all the economists confused. Nouriel Roubini, completely flat-footed on this one. Peter Schiff, completely flat-footed on this. Mike Shedlock, he got it. Steve Keen, maybe not so much. Max Keiser, yes, we got it. Here's a $100 trillion Zimbabwe dollar that was given to me over the weekend by Mike Maloney, who's making a film about gold and silver in Europe right now. Thank you, Mike. A timely reminder of the shenanigans that can happen on the central bank level. In that case, of course, that was hyperinflation. But what you're talking about, Stacy Herbert, is a deep, prolonged bout of caustic deflation. Walmart, crashing prices, commodity prices down. Robert Prechter, he's got it on the deflation front. However, he's wrong about gold because gold is going up in a deflationary environment. It's counterintuitive, but it's really happening, and it's going north of 5,000.
Well, Don Cox continues on this thread, and he says, "We think that future historians may well report that the moment when gold once again became a store of value was when the dollar began soaring in response to the stench of seared grease, and gold climbed right along with it."
Of the fiat currencies, the U.S. dollar is the leper with the most fingers. But it won't hold up again. It'll deflate against gold as well, Stacy Herbert.
You remind me of Alan Greenspan there this past weekend. U.S. debt and the Greece analogy. This is Alan Greenspan talking about this very issue in the Wall Street Journal. He says, quote, "With huge deficits currently having no evident effect on either inflation or long-term interest rates, the budget constraints of the past are missing. It is little comfort that the dollar is still the least worst of the major fiat currencies. But the inexorable rise in the price of gold indicates a large number of investors are seeking a safe haven beyond fiat currencies."
That's right. The U.S. dollar is the most attractive horse in the glue factory. Now, Alan Greenspan is correct to make that point. And the fiat currency worlds are imploding. The fact that people are both buying gold and the dollar, don't get involved in the dollar versus gold. Gold will ultimately, the gold vigilantes, as I call them, and I think I am the #1 gold vigilante in the world, seen by more folks around the world than any other business broadcast on planet Earth. You have to discount that into your thinking as well, paper bugs.
Well, Alan Greenspan is very concerned in his editorial for the Wall Street Journal, saying that the fact that the dollar is rising is giving great complacency in the U.S., that people are thinking that we can run these deficits and nobody's making us pay for it.
Yeah, well, that's just... it's just not going to work in the end. I mean, look at what's happening in the Gulf of Mexico. They're going to lose 1 million jobs, permanent job loss of 1 million. And remember, also, eco-terrorism, as it's been perpetrated by British Petroleum, is also highly deflationary.
Well, here's a take by William Pesic of Bloomberg Asia, and he says, "China turns tables on AAA debt time bomb nations," regarding this very issue. And this is referring to China deciding to revalue their yuan, letting it float. And on the one hand, this is positive that, they're going to develop their own economy. And, workers in China are starting to rebel against their slave wages. So he says that consider why gold is up more than 30% over the past year. Many investors have zero trust in the most liquid currencies. Those most coveted AAA credit ratings mean less with every passing day as the biggest economies issue more and more IOUs. It would be a crime if the G20 left Toronto without exploring how to restore the trust. So the G20 are meeting this weekend. This is part of what's happening with all these currencies because they're, I guess, expecting major changes. But he notes that, China is the one stepping up to the plate, while in America, the biggest debtor nation and the biggest economy in the world is just shouting at everybody else. And so his final statement is, it also makes a mockery of rich nations demanding that developing ones do all the heavy lifting.
Well, do you want to hear some inside information, Stacy Herbert?
Sure I do.
Okay, don't tell anybody.
Okay, hold on.
Just between you and me. Don't tell anybody out there. My sources tell me that China is buying more gold.
Wow, that's a really top secret.
Well, what about the story about who's going to get together and create a new gold-backed security currency? It was.
Well, this is Jim Rickards is speculating this.
He's speculating.
It's just pure speculation.
So that's another kind of in the margins. They've got some speculation. I don't know if we're going to cover it this week, maybe next week. But there's news about a new gold-backed currency we'll be covering in a subsequent show.
And then finally, on top of all this, so this is the debt crisis exploding, right? And how do you you need to make the debt go away in order to end the debt crisis. And speaking of having the poor do all the heavy lifting, preying on the weak. So this was a New York Times expose this past weekend about peddling relief. Debt settlement firms put debtors in deeper hole. So many of the subprime lenders, as their business dried up with the collapse of the U.S. housing market, have turned to debt consolidation firms. And it turns out that the long recession has delivered an abundance of customers, debt-saturated Americans suffering lost jobs and income, sliding toward bankruptcy. The settlement companies typically harvest fees reaching 15 to 20% of the credit card balance carried by the customers, and they tend to collect upfront, regardless of whether a customer's debt is actually reduced. And then now the New York State Attorney General has found that actually less than 1% of the clients actually ever have their debts reduced. But in the meantime, their debt loads actually rise because these debt consolidation firms have basically told them to stop paying their debts. And the creditors come after them very angry.
With stun guns and tasers. I say, let's impeach Barack Obama and put Bernie Madoff in the White House.
Well, part of it, according to the New York Times, a 2005 alteration spurred by the financial industry made it harder for Americans to discharge credit card debts through bankruptcy, generating demand for alternatives like debt settlement. So you remember the 2005 bankruptcy bill made it very difficult to discharge your credit card debts. So people are being forced into these predatory companies that are, just basically ripping off and looting from the very poorest and desperate in America.
Well, if you took the predatory companies out of America, you'd have nothing left. Except guns and donuts!
And gold.
And gold. Well, some for the lucky few. Stacy Herbert, thanks again for being on the Keiser Report.
Thank you, Max.
Don't go away. Much more right after the break, so stay there.
Every month, we give you the future. We help you understand how we'll get there and what tomorrow will bring. The best in science and technology from across Russia and around the world. Join us for Technology Update on RT.
Welcome back to the Keiser Report. Time now to go to New York City. Talk to Gary Rivlin, author of Broke USA. Gary Rivlin, the title of your book is Broke USA. First of all, welcome to the show, and what's going on?
It's a booming time for the poverty industry, which is the topic of my book. This is an upside-down world where people who have no money in their pockets is really, really good for business. Okay, so you call it the poverty business or the poverty industry. How does that work? Well, it's counterintuitive. It's this kind of business where people who have no money are so desperate for quick cash that they'll pay virtually anything for a loan. So you've got pawnbrokers charging in the U.S. charging between 60 and 300% interest annually. You've got a new kind of lender called a payday lender. They make cash advances against your next paycheck. They're charging 400% or more in interest. So while on the one hand, businesses like people who have money in their pocket, there's this unique category of businesses I'm writing about that want you to have no money in your pocket.
Okay, so basically what we're talking about here is medieval debt peonage running rampant in America. Now, apparently by 2006, there were more of these payday lenders in the U.S. than there were McDonald's and Burger Kings combined. So, in other words, if I get the business model correct, these folks at the payday lending shops, they lend people against their paycheck coming in a couple of days, and when you compute the annualized interest rate that they're charging, it's like 400%, 500%, sometimes higher?
Correct. So it doesn't even have to be a paycheck. It could be your government aid check, Social Security. Nowadays, payday lenders, some of them at least, are taking your unemployment checks. And what the payday lenders would say is, we're just charging a flat fee. It's not an interest rate. It's $15 per 100, $20 per 100, depending on the state. But in fact, if you calculate that as an annual percentage rate, which by law they must, it works out to 400%, or if you're unlucky enough to live in the state of Missouri, it's 650% annual interest rate.
So what's remarkable, Gary, is that down on Wall Street, if you're one of the big Wall Street banks, Goldman Sachs or JP Morgan, your cost of borrowing money is effectively zero because of all the low interest rates at the Fed, plus all the arbitrage tricks you can do intra-market, different Forex arbitrage. Your interest costs are not, sometimes below zero. But down there on Main Street, it's hundreds of percentage. This sounds like a complete...
Yeah, there's been no connection whatever between the rise and fall in interest rates, the cost it costs a payday lender to borrow, and the charges they pass along to their customers. What the payday lenders would say, though, is that defaults are really high. About 1 in every 20 people fails to pay back the loan, which, of course, eats up a lot of their profits.
Right, but just like moral hazard has destroyed the American economy by making the Wall Street banks effectively immune to any prosecution, so too the payday lenders. Now, following the collapse of the U.S. housing market, the New York Times this weekend revealed that many of the subprime mortgage lenders have turned to the debt consolidation business. Tell us about the debt consolidation business, please, Gary Rivlin.
The subprime lenders don't really have that much to do. And so what they're doing is working the other half of the equation. They help get a lot of people into financial trouble, and it's leading to foreclosures and pain all around. But now what they're doing is trying to help, for a big fee, people who are in this mess. So they claim that they're going to help you unravel the mess you're in, whether it's, you're stuck in a mortgage that you can't afford, or you're so deeply in debt with credit cards because you lost your job, you lost hours, that they're supposedly help you get out of that. But instead what happens is they're very quick to pay to collect the fee, but they rarely are able to help people.
Let's name some names here, Gary. Who are the biggest banks involved in the predatory lending?
If you look at payday lending to start, you have Morgan Stanley has helped fund the rise. You've got Wells Fargo. You've got Wachovia. You got Bank of America. But if you broaden it and include subprime credit cards, Goldman Sachs is huge in the subprime credit card business, in the way that they've funded subprime credit card borrowers. If you look at subprime mortgage lending, HSBC, based in London, for a couple of years there was the largest subprime mortgage lender in the United States. Citigroup, has been enormous in the subprime mortgage lending business. Wells Fargo, JP Morgan Chase has been big in that business. JP Morgan Chase is huge in this weird business called the instant tax refund. Well, once a year, the working poor in the United States feel rich because there's a programmed earned income tax credit that means that they get, typically if they have kids, 2 or 3 months worth of their pay as a tax return. So you see in inner city communities, working class communities all around the U.S., these instant tax mills where they'll say, don't wait the 2 or 3 weeks, it'll take the Internal Revenue Service to send you a check. We'll give you your refund today. And the part they don't say as loudly is for a 60, 100%, 200% interest rate.
All right, so we're talking about loan sharking. We're talking about the mafia in America getting some serious competitive pressure from Goldman Sachs, Morgan Stanley, JP Morgan, and the gang, what I call the financial terrorists down on Wall Street. Let's talk numbers in terms of size of this business. I know the paycheck lending outlets combined have more outlets than McDonald's and Burger King combined, but talk to me a little bit about the size of the overall loan portfolio they're controlling and what percentage, if you can, of the whole U.S. loan matrix is involved in loan sharking, predatory lending, mafia lending, Wall Street terrorism.
Well, I will, but first I really have to define the loan sharks here. They charge typically in the U.S. 2%, 3% a week, which works out to 150% interest rate. The payday lenders are charging 400%, 500%, 600%. So let's watch it about maligning the name of the loan sharks.
That's a good point taken, yes.
What drew me to this topic, I was working for the business desk at the New York Times. What drew me to this topic is what huge business this is. The payday loans are typically $300, $400, $500 at a time, but added up, it works out to more than $40 billion in loans a year. You look at the rent-to-own business. There's publicly traded companies collecting billions of dollars a year. Check cashing seems such a nickel and dime business, but we've got 6 publicly traded companies in the U.S., or 7 if you include Walmart, in the check cashing business. Payday lending. You've got 7 publicly traded companies in the payday lending business. So what I thought, as a citizen of New York, was that this was a very small-time business, but you lift up the covers and you find that this is very much a Wall Street business.
Right, and it's a multi-tens of billions of dollar business. It attacks the weakest in society, and it's absolutely a scourge that you would think the current administration in Washington would have an interest in getting rid of. But of course, in this economy, where the GDP is defined as oil spills and predatory lending, they actually think that this is how they're going to grow their economy, by creating debt slaves in America. Now, what about that law in 1863, I believe, if I could be off by a few years, that outlawed slavery? Isn't this reintroducing slavery?
Well, I mean, to just defend what's going on in Washington right now, there is a proposal. The Obama administration last year proposed a Consumer Financial Protection Agency that, in fact, would more closely monitor the payday lenders, the check cashers, subprime mortgage lenders. In both the House version, the U.S. House of Representatives versions, and the U.S. Senate version have some version of this agency, and negotiators are actually in Washington right now trying to put the finishing touches on that bill. So it's not that they're doing nothing, but what's been frustrating for those who want to fight this is there have been proposals in the Senate, there have been proposals in the House to create a national usury law, to put a cap on the rates that lenders could charge. Many states around the country in the U.S. have a usury cap, but the payday lenders spend a lot of money on campaign contributions and lobbyists to get an exemption. There's measures before the House and Senate to take away those exemptions and say the U.S. should have a 36% usury rate cap.
Okay, let's talk about George W. Bush's term in office. In 2005, the bankruptcy law that was put into place. To put this into some immediate historical context, can you speak a little bit about the importance of that and how that factors into today's dilemma?
Yeah, the Bush administration gave a bill that made the bankers very happy. They in quotes, reformed bankruptcy, but what that meant, it would be harder for the individual person stuck in a loan to get out. And now what we're seeing, now that so many people are facing hard times and bankruptcies are on the rise, it's been a very effective tool for the U.S. banks. It's really hurt the average consumer here in the U.S.
And, of course, that's going to reduce the GDP, reduce tax take, increase the deflationary spiral that the U.S. is encountering, and put the U.S. economy at even a greater competitive disadvantage against economies around the world, simply because there seems to be no protection for people against super loan sharks charging hundreds of % a year interest in a way that would make Tony Soprano blush. I mean, it's absolutely shocking. And let's see, I mean, what else can we say about it? Why, the argument that you hear is, well, they're making funds available to people who couldn't otherwise get funds. But isn't that the same as saying that the heroin dealer is making heroin available to people who wouldn't ordinarily get heroin, or the crack dealer is allowing to give people crack? I mean, you're giving people, you're offering them debt peonage. That's not a good thing.
Well, actually, a lot of the payday lenders borrow from the drug dealer method. They give the first payday loan, if not for free, at a very reduced rate. And, there is this argument. In fact, I started off this project thinking, well, maybe a payday loan is a good thing. You don't have a rich uncle. You don't have a credit card. What do you do if your car breaks down? What do you do if you're out of cash? The problem is that the person who's so desperate today to borrow $300, let's say, they're paying $50, $60, $70 fee for 2 weeks. How are they going to have the extra money in 2 weeks to pay it back? back. And then what you see happening is rollovers. People just owe this for months and months and months and months. Some states outlaw rollovers, so instead what you see is people pinballing between stores. So they borrow from store B so they get paid back store A, but then they get in trouble with stores A and B, so they go to store C. And you've got millions of people in the U.S. who are just have these out all the time. They're not just paying, in effect, 400% interest for their money. They are paying 400% interest for their money.
So give me a ballpark estimate. How many debt whores are in America right now?
I'm sorry, how many debt what?
Whores.
I'm not really quite sure. I mean, there's hundreds of people in entrepreneurs in the payday business.
Gary, I'm talking about the people who are having their debt rolled over every week. They got to get their fix of their $75 new debit from the predatory loan officer. They're debt whores, like crack whores or heroin whores. You know what I'm saying? How many victims? How many debt whores in America now, thanks to this regulated market from Wall Street and Washington that's turning America into debt peons and medieval serfs? How many of them now?
Okay, so there's 10 to 14 million people a year who take out payday loans, and about 1 in 5 take out 20 or more a year. These are every other week. 20 or more a year is virtually for the entire year. So doing the math, you've got 2.5 million people at any given time who are paying 400% interest. To put that into dollars, for your $500 loan, you're paying $2,000 or so a year in fees to borrow that money.
Well, God bless America. Thanks so much, Gary Rivlin, for being on the Keiser Report.
Okay, my pleasure. Thank you.
All right, I want to thank my guests, Stacy Herbert and Gary Rivlin, author of Broke USA. It's a must-read. I'd like to thank everybody who's been sending me emails and to continue to send me emails at keiserreport@rttv.ru. Until next time, this is Max Keiser saying bye, y'all.